I call this meeting to order.
And they're streaming.
Can we get a roll call vote, please?
Yes. LeBlanc,
Here.
Fenton, Denham,
Here.
Yancey, Meenan, McConnell, Milton,
Here.
Westfall.
Here.
Mayor, no quorum present.
Okay, so we do not have a quorum. However, we would enjoy the presentation. We've been looking forward to some of this information, and when we get this, it's equally important for the board, the full board, to hear some of this update. So as we go through this, I'm going to suggest you can stay at a pretty high level, and then we'll give some guidance of how much of that to put in a board meeting, because, you know, we don't want to take up a lot of time at the board meeting. But I know there's new and some good information we're going to be hearing. So let's start off with the approval of the we can't vote on it. Is that correct, Madam Clerk?
You're correct. They'll just have to roll over to another meeting.
Yeah.
And so, just to be clear, we're talking about August 9th meeting for the Board of Aldermen. That's where we
Okay.
would pick this up, and so when you go through that.
Very nice.
So
Thank-
nothing can be approved, but they will be streaming and moving on.
Very nice. And so we'll start off with the audit report from Mr. Ben.
Yeah, and thank you, Mayor and members of the committee. We've got a full agenda today, but there's two very important pieces. One's with the external auditors and one's with our investment firm. The rest of it, I think you've seen before, and I'll walk you through it. That's not an issue. As these guys go through their presentations, please feel free to ask them questions. They haven't been prefaced by me to answer or to say anything, so they're going to tell you, they're going to give their presentation. Michael's got things by rules he's got to be able to explain to you. So he's got a presentation he'll go through. Michael Keenan's with Hood and Associates. He's a senior manager. He is our key contact for the city's external audit. Michael?
Thank you. Good morning, everyone. Again, my name is Michael Keenan. I'm with the auditing firm of Hood and Associates, here to present the draft reports of the financial audit and compliance audit for the fiscal year ended December 31, 2021. Included in your packet would be the annual comprehensive financial report, would have been the larger document, as well as the single audit for the current year. The City of Branson was subject to a single audit, which hasn't happened for quite some time. The single audit relates to the expenditures of federal awards. And also there's the required communications and management letter. I've included a little PowerPoint that I'll go through to help summarize the audit and our responses.
Excuse me, Michael, before you get started. Lisa, this presentation is online, is that correct?
We will have to get the PowerPoint is not.
Okay.
It's my understanding.
Okay, we just like to make sure it's online so everybody can, and I know this is a small audience here, but we do have several that are
Okay.
We will make sure it's online.
Okay, thank you.
Overall, okay, great, thank you. A little bit about Hood and Associates. Again, we're formerly known as Cochran Head Vick and Company. That's what we completed the audit under last year, but we were acquired by Hood and Associates. They're a firm out of Tulsa, Oklahoma, and they maintained all of the offices of Cochran Head Vick and Company in both Kansas and Missouri. So we did have a name change. We've been serving Missouri and Kansas, as well as Oklahoma and Texas now. We also go what's called through a peer review, and that's where an outside independent auditing firm will come in and review our internal control and quality control processes regarding audits, and we've been awarded the highest rating as a result of that review. We're members of the American Institute of Certified Public Accountants, the AICPA, which govern how auditors conduct their audits. We're also a member of the AICPA Government Audit Quality Center, as well as one member of the Auditing Services team, which happens to be myself, as a member of the Government Finance Officers Association Special Review Committee, and that's where I get to review other governmental comprehensive annual financial reports to see if they qualify for the award. And we're also licensed to practice in the states of Missouri, Kansas, Oklahoma, and Texas. Should work now. There, whoops. The scope of our audit, again, is the annual comprehensive financial report. Again, that's the larger document. And what I say, the city participates in the Government Finance Officers Association, the GFOA, Certificate of Achievement for Excellence in Financial Reporting. The city has received this award 16 consecutive years through the 2020 report. This 2020 report will be presented to the GFOA for consideration. And the management and staff believe that it will also qualify for that prestigious award. So that should be something that the city should be proud of. Also, the scope of our audit included a single audit, and that was necessary as the city received some ARPA funds during the year. And what qualifies for a municipality to have a single audit is if they expend greater than $750,000 of federal awards, which you did this year. And we'll go over the results as later in the presentation. Our responsibilities as auditors is to conduct our audit in accordance with generally accepted auditing standards, as well as government auditing standards and the uniform guidance. The uniform guidance relates to how we conduct our audit related to your federal awards. Our responsibilities also include to plan and perform our audit to obtain reasonable assurance, but not absolute assurance, that the basic financial statements are free of material misstatements. What that means is we take a risk-based approach to our audit, and we do not audit, we make selections based on a test basis using materiality. So it means we do not audit every transaction. Therefore, we cannot give absolute assurance that the financial statements are free of material misstatement. Our responsibilities also include reporting on internal controls over financial reporting, as well as compliance with financial-related laws and regulations. The Auditing Standards Board of the American Institute of Certified Public Accountants, the AICPA, recommend that we communicate these matters to the governing board. Illegal acts, none came to our attention the result of us performing our audit procedures. Changes in significant policies, accounting policies. In FY 2021, there were no significant changes in accounting policies. We also had no difficulties or disagreements with management. And we're pleased to report we had cooperation, we had full access to all the books and records and any transactions or support that we wanted to select for testing. Now, financial and compliant audit addresses really these three basic questions. Are the financial statements free of material misstatement? And at this point, we have issued an unmodified draft opinion. These financial statements are on draft to give everyone a chance to look at those and review those, that indeed the financial statements are fairly presented in all material respects. Somewhat known as a clean opinion. That's the highest level of opinion that auditors can provide for external financial statements. The second question, are internal controls over financial reporting adequately designed and operating effectively? Our response is we did not identify any deficiencies in internal controls that we consider to be a material weakness. Again, had we done so, we're required by our profession to report those matters to the governing body. And finally, did the city comply in all material respects with finance-related laws and regulations? Our response is no non-compliance was noted with finance-related laws and regulations that govern the city's operations. In our other management letter comments, we contain comments for suggestions for best practices as well as improvements in internal control. We have 3 items that we included, and those are included in your required communications, and management has provided their responses. The first one relates to budgeting, and during the year end, we had a number of funds that were over budget, with the most significant one being the debt service fund that was over budget by a significant amount. And what that relates to is during the year, there was approval of issuing the lease purchase agreement to refund the MDFB 2011 bonds. Well, that was approved. There wasn't a formal budget amendment done to recognize that those sources of funds came in and that they were going to be used to refund those obligations. The second management letter comment relates to key personnel, and the city's at risk of loss of continuity, and well as internal knowledge when unanticipated absences occur. And we're just recommending that the city evaluate the risks to those and develop plans to help mitigate those risks. And finally, the last one is future accounting pronouncements. Our profession seems to continue to issue new standards, seems like every year. The only one that might have a significant impact as far as the city of Branson is GASB's number 87, which relates to leases. I know that staff is aware of that, and they'll be trying to implement the information necessary to implement that new standard, which will be due next year. Hood & Associates certainly appreciates the opportunity to serve as the auditors for the city of Branson. Special thanks to Lisa and Ben and Jolynn, as well as the staff. Very professional and provided us the information that we needed to complete our engagement. And with that, that kind of concludes my PowerPoint presentation. I'll open the floor to any questions that I might be able to answer.
Michael, you mentioned, and I think it was under the risk portion, that we've had a vacancy in our finance department, and we have fulfilled that role with Baker Tilly. So with your comment of, you consider that still a risk of, is that what you were referring to, was the changes within the finance department?
I say not necessarily. What we have to do as auditors is we have to evaluate internal controls of an organization in order to plan our audit. And based on that assessment of those risks, then we implement procedures to correspond to those risks. So I'm not saying, I said that risk always is present related to internal controls. Certainly having Ben's group come in to help monitor things as, you know, you're in this transition cycle is good. We think that that's a positive.
Okay, so I just wanted to make sure that that was clear, that with Ben with Baker Tilly coming in to handle our finances, that city's in good hands with that. I don't want the public to think that we don't have a plan or a current process that is.
I think overwatch is the word, proper overwatch.
You need, we gave microphones.
That we have proper overwatch.
Yes.
I mean, the city had a system of internal controls previously, and always has had those as far as the purchasing policy, personnel manuals, following the initiation authorization of those transactions. You need somebody in the management level to oversee all those, and that's what you have with Ben's firm. So again, I think that's a positive move that the city did in this transition time to fulfill those obligations.
Okay, thank you.
Your Honor, can I have a question. So for clarification, this audit in December 31st, 2021, right?
Correct.
So, but this review or your finding is for 2022, which is occurring right now. So my question is, it's not from the audit year?
I don't know if I'm following your question.
Addressing the change in our accounting department. There
Was
was
it-
no change
Well,
in this
yeah,
year that we're
we
on.
audited the 2021 financial statements and considered the controls in place at that time. And since that time, there's been changes. And I thought I was referring, your question relates, how are we doing now in 2022 versus 2021?
I just, so that information, though, is in the 2021 audit.
Yeah, I'm not sure I understand.
Their work is, you're right, their work covers the calendar year, 2021. But until this report is issued, they have procedures that go after the end of the year up until the time the report is issued. That doesn't mean the financials are audited. They're just looking at any significant changes within the city. And keep in mind, their management letter comments are recommendations. They're not a ding in any way, shape, or form for the city. This is as an external consultant. He's saying, here's things that maybe you ought to take a look at. They're not bad. They're just things that you ought to keep in mind. Just like the GASBs. There's a ton of GASBs out there. And our staff does a really good job staying on top of those. All he's saying is keep doing that. And there's certain positions within the city that if something, God forbid, to happen to them, they'll present problems. Whether it's payroll, whether it's a police chief, there are certain things that succession planning needs to exist for. And what he's saying is, as that relates to internal control, just continue to be aware of that. And then we have an opportunity as a staff to reply to his comments, saying, good point, here's what we're doing. And within the document, that's what we're going to do. That way, when it goes out on the web, people will read it and understand what the city's actually doing about it.
That's great, because I know there's still some uncertainty within the community, knowing we had some changes, and where are we?
And Jan's doing the staffing study.
Yeah.
That's going to be a big piece of this, and the budget for that matter, yeah.
Thank you.
Thanks, Ben. Sorry, I wasn't. Did that answer your question?
Yeah, I just think we're 6 months, over 6 months into, 7 months into the calendar year, but audit. And so potentially we're into next year's audit, or this next audit for 2022. That's what I was looking at.
Yeah, and when we come in to perform next year's audit, we'll have to, again, gain an understanding of your internal controls to be able to plan the audit. And I would say, had you not hired Ben's firm, then your internal controls probably would have had some issues with the initiation, authorization, approval of transactions, because you might not have had somebody doing that function.
That's fair.
And then that would have raised our consideration of your internal controls, our risk would have been greater, and we would have had to audit maybe differently. So I hear what you're saying. We're reporting on 2021, but our management letter is looking ahead, best practices. And it's unusual when a city has the circumstances that you had, where you had a lot of institutional knowledge and key positions of management that are no longer here. And that's a risk every municipality has, and any business has. What happens when that unanticipated absence occurs? Are we going to be ready? And I would say most governments and businesses aren't ready. And so we're just suggesting that you take a look at that now that it's happened and plan accordingly going forward.
Fair enough. Anybody else have questions? That's good. Thank you, Michael.
All right, thank you.
That brings us to item number 2.
You're on.
So one of the things that the board asked some time ago is to actually decipher some of your investments and where it goes. So Patrick Smith is with BOK in Kansas City, and we asked him to come down and kind of give a overview of your portfolio, but he is thinking ahead, and what he's going to do is kind of give us an overview of what the economy looks like at a fairly high level. And going through what he's got, I mean, there's 41 slides here. He promised me he's not going to go through each one of them, just the high points. But I think it's going to be a good education, at least for me, and I live in this world, to hear somebody else talk about it. But if you've got questions, obviously, when he's going through this, just let him know.
Thank you.
Mike or Patrick?
Yeah, so as Ben said, I'm Patrick Smith, and I work for BOK Financial in Kansas City. We're about a $50 billion bank headquartered in Tulsa, and we have offices, primarily around the Midwest and the Southwest. We have capital markets offices in Little Rock, all over Texas, Kansas, Milwaukee, Colorado, some in California. We've got people, quite frankly, all over the country. I primarily work in the Midwest. I have.
Excuse me, Mike. Chad, is that picking up on the audio?
If you could pull the mic up just
Oh,
a bit.
I'm sorry.
There you go. Perfect.
There you go.
Thank
Thank
you
you.
very much.
One of the first times somebody's told me I'm not loud enough. So thank you. I work with financial institutions, municipalities, school districts, insurance companies, again, like all over the Midwest. I work with cities on the East Coast. I work with states all over. And so my primary focus is the fixed income market. And that's what, with cities, especially in the state of Missouri, you guys have state statutes that you're limited to as far as what you can and can't purchase as an investment. And so the beauty of it is they're pretty, the parameters are pretty tight. Like, you can't buy anything past 5 years. I don't know, has anybody had a chance to look like at the city's investment policy? That might be something if you want to kind of catch up on some reading, to see what like before you go to bed, maybe, it'll put you to sleep. But those are the rules that I have to abide by as far as what I suggest and what we purchase for the city. And so what I'm going to start with is just kind of go through a high level. It's just this button here, right? Oh, I got it. Oh, okay. I may look young, but I'm awful with technology. So, and actually, I'm not looking as young as I used to either. This morning, there's been, and I talked to Ben. I could go through this stuff over a long period of time, but I'm going to try to give you a high level. The bond market right now is the most volatile that I've seen it almost in my career. We're coming out of a pandemic. The government's been, showering, individuals, companies, in the form of PPP loans, municipalities. They've been given money with, the CARES Act, the ARPA Act, and whatnot. And so what we're seeing is, yesterday the Federal Reserve met and they raised short-term interest rates 75 basis points. I'm sure everybody saw that on the news. And so what we had to follow this morning was we had the first look at the second quarter GDP number, and it was negative. So now we have 2 consecutive quarters of negative growth. And if you look back from your Econ 101 class, that would be the textbook definition of a recession. Of course, they never tell us we're in a recession until 6 months or a year after it already started. So just to give you a little bit of an idea, this is a yield curve. The green line was when I printed this off like a week ago. The blue line was a quarter ago, and the red line is a year ago. So if you can see, Treasury rates have jumped up, super fast, all because of what the Fed's been doing with raising Fed funds rates. So what we've seen in the course of the last year is them raise rates faster than they even did in the last tightening cycle. To get to where we are today, it took them 3 years. in the past. So, I mean, they have raised rates quickly to combat inflation. Again, everybody sees that. So just to give you an idea, the GDP number came out this morning and it was negative, and rates just keep falling. I mean, they raised short-term rates yesterday 75 basis points, and rates fell. The GDP number came out this morning, and rates fell even further. So when you try to analyze what the future holds for us, this yield curve that I have up behind me, that's what normally predicts the future. And you're seeing we're getting an inverted yield curve. It continues to invert more and more and more. Like, for instance, you know, the 6-month Treasury yield's 283, and the 10-year yield's 265 this morning. So I wasn't in the investment business in the 80s, but my mentor told me that, you know, the next time that the 30-year Treasury gets to 16%, I need to sell the farm and buy all the 30-year Treasury bond that I can. Because what happens is human nature in this particular type of a market, everybody wants to invest short because the rates are higher. And so we'll talk a little bit more about that in a few minutes. This is what we kind of look at, it's a screen on Bloomberg called WIRP. It's the Fed funds implied rate, you know, where rates are going to be in the future. And this changes every minute of every day, the odds. And so what the Fed has been trying to broadcast to us is they're going to continue to increase rates to fight inflation. But the crazy part is if you look at this chart and you go out to March, you can start to see that that's when the market is telling us the Fed might start to cut rates. So all of a sudden, as they continue to raise rates to slow down demand, that will probably cause some type of a recession. So that's what we've kind of got our eyes on. This morning, when I looked at this chart, it's moved up to February as being the time that they might start to cut rates. So we continue to need to watch this. Next chart, same thing, just another graph. Like I said, if you look at it, you can see that in March is where the pendulum was starting to swing, but again, that's moved up to February. And like I said, stop me if you have any questions about any of this. CPI, we all hear about CPI. We all know how much gas costs. We know how much food is increased in the grocery store. And this is what the Fed's trying to fight. The Fed's trying to raise rates. And so quite frankly, you know, if I was in Washington, D.C. today and sitting around the water cooler, I mean, I'm hoping that some of the guys are saying, hey, look, it's working. We're raising rates. Growth is slowing. That's what they want to happen. And they want it to happen, and they want it to happen slowly and have a slow, you know, like a slow landing. We don't want to have a crash landing with the economy and go into a depression or a deep recession. So right now what's happening is precisely what they want to have happen. I'm not going to really spend a lot of time here. This is that, if you guys ever want to look at where the market or where the Fed thinks inflation is going, just Google the Atlanta Federal Reserve has a number called the GDP Now. They update it probably once a week. So last week this was updated, and they wanted minus 1.6. Well, the number came in to -9. So kind of pay attention to that. Watch the news too. The last couple of days, this week, the Biden administration, you heard a lot of people talking about we're not in a recession, we're not in a recession. I mean, they don't want you to think we're in a recession. Whether we are or not still remains to be seen, but growth is definitely slowing. And then I'll talk about some of the reasons why. Skip that. When you look at, this is a chart of the 10-year Treasury minus the 2-year versus unemployment. And all I'm really trying to illustrate here is that when you look at economics, there's just everything's cyclical. And it comes up and it comes down. And so like what's happening right now is the labor market, we have an unemployment rate below 4%. It's hard to find people to work. The people that they do find to work, they command higher wages. So higher wages result in higher prices. And so all this, again, creates higher inflation. And so what we're trying to find out is, if you look at the unemployment numbers that come out the first of every month, like we'll have one next Friday, when you start to see the unemployment rate go up, that's when the economy is going to start doing good. And think of it this way. I mean, it's the denominator. There's a phrase, the labor force participation rate, and that's what's kind of come down. We've had the Great Resignation. We had all the stimulus payments that went out during the pandemic, and people left the workforce. Maybe they're driving for Uber. I mean, whatever it is there's a lot of new jobs, a lot of things happening. So we want to kind of, as as the unemployment rate falls and it's harder and harder to find employees, you have to pay them more money. Now you have wage inflation. Wage inflation is pretty sticky. I mean, you don't give people, you don't hire a new employee and pay them a higher rate than you paid the last person, and then a year or two later say, okay, sorry, inflation's dissipated, we're gonna take some of your pay away. That stuff is sticky, it stays there, it creates higher prices for things. So we're kind of in the late cycle of that growing economy, I think, and the labor market is telling us that. Same thing, the consumer, real personal consumption versus personal income. The consumer makes up 70% of GDP. GDP just came out negative. I mean, you probably saw in the news this week that Walmart's guidance was lower going forward because people are purchasing more food and not enough of the high margin type products like your TVs or whatever. I mean, the food prices have gone up so much that we're spending more money on food and less on other things, and that will probably continue. Home affordability. I mean, I live in Kansas City. It used to be, I assume the market is similar around here. Somebody would list a house for sale, it would sell in an hour. I mean, it was insane. And the interesting part about that is I came home from dinner one night and told my family we're moving. I'm gonna slap a really high number on my house, and they're like, well, where are we gonna go? And the reason I share this story is that, of course, they weren't on board. They didn't want to move. I have a daughter who's a freshman or sophomore at Missouri, and she doesn't really care, but my son's a junior in high school, and he was totally against it. But I told him we were going to move into an apartment. All right, so I started looking for apartments. Tried to find a 3-bedroom apartment in Kansas City. And if you do find one, it's more expensive than my house payment. And so rents are now starting to go up. Another sign of inflation. There were some people, I think, around that may have sold their homes and taken advantage of the high interest, the low interest rate market, everybody buying houses, you can get more for your house, but then either you just have to go buy the same type of house for the same amount of money, or you go rent something and you wait for the real estate market to fall and buy something cheaper. And so I missed the boat on that. We're still in our house. So sorry. Again, interest rates have kind of skipped through some of this. Here's another, when we talk about inflation by household income, where if you look at the middle quintile, the folks that are making between $52,000 and $85,000 a year, I mean, that is kind of your average, citizen in the United States. And what's happening now is that inflation is basically costing them about $4,200 more a year. And that hurts. I mean, it hurts everybody. And I think I just saw something the other day that, just gas. I mean, they're saying that the price of fuel is costing folks about $5,000 more a year. So, I mean, all these, again, just more inflation, and that's what the Fed's trying to fight by raising rates. Consumer confidence, probably, at almost an all-time low, from the 50s. The University of Michigan puts this out once a month, and the numbers have just been, as you can see in this chart, I mean, they've been plummeting. I mean, and it's not good. People aren't happy about how expensive all the things are that we have to purchase on a day-to-day basis. Same thing anytime inflation gets above 4%, there seems to be somewhat of a correlation to having some type of a recession. Just thought I'd point that out. As prices keep going up, that's what causes, the demand to fall. So I guess right now, I mean, I kind of hit a lot of things. I mean, I don't know where we're going to go. There's a lot of people saying that we're not in a recession. And I'll just add kind of a sidebar comment as a personal experience. When you look at those jobs numbers that come out, once a month, the first Friday of the month, and they say, 150,000 jobs were created, and the unemployment rate's 3.8% and all that stuff. I was actually counted in that survey one year. It's all based on your address, not your social security number, not your name or anything. But what happened is this gal came to my house, and she said I was the very first person that actually answered the door. Most people don't even talk to folks when they show up to your house, but I invited her in, and again, she stayed there for about an hour and a half because I was asking her all these questions, how it's counted. So when you see that number on Fridays, the sample size or the survey size of the number of folks that are asked the question about whether or not they're working, it's 50,000 households. So what I'm trying to say is I'm 53 years old and I've been doing this for almost 30 years. Some of the ways that they count these numbers, I question them. And that we need to go a whole lot farther than that, but the point being is there were months where I didn't even get a phone call. So how are those accurate numbers, right? And that's how people are basing policy on, economic policy, in the current administration. So if you look at this summary of thoughts, kind of where we're at today, I think would be more on the bottom part of the chart. It looks like that the Fed may kind of start to slow down a little bit. Nobody wants to be the person that's at the helm when they pull the punch bowl. I mean, if they really did the right thing, they probably need to continue raising rates, and because inflation's awful. I mean, we all know that. We've read about it. We're experiencing it today. And so if the consumer starts to slow down and isn't spending money like they have been the last 6 months or a year, I mean, we came out of a pandemic where everybody was locked up. I mean, I have numerous clients that I talk to that are all going to Disney World. Disney World's packed, but most of these folks bought these trips like in January. I mean, now all of a sudden, like I bought an airline ticket to go to Denver next week, and it's like, usually it's under $200. This year it was almost $700. I mean, and then I read an article in the Wall Street Journal today that said the airfares are starting to come down. So hopefully that will happen. I'm going to Madison, Wisconsin the week after that to teach at a graduate school, and my ticket was almost $900. Madison's not the biggest airport to go to, but it was very expensive to fly there. And then we like to do other trips, like I go with some friends to Canada, usually once a year, but some of the guys that people hadn't been vaccinated, so Canada still won't let people in. My point is the economy is not hitting on all cylinders. I mean, I can go on and on with my personal stories, but I mean, you go get your oil change in Kansas City at a Jiffy Lube and you pull in there at 5:45, they close in 10 minutes. I mean, that didn't used to be the case. So, I mean, they're not either having to charge a lot more money per oil change, or they're not making as much money as they have in the past. And that, again, has a lot of effect on the economy. They're not going to grow. They're not going to build new locations. They're not going to hire more staff. So it looked to me like the way the market interpreted Chairman Powell's comments yesterday is that they probably aren't going to keep raising interest rates 75 basis points. But a couple quick comments about that. The Fed doesn't meet again until September, the latter part of September. But there's a meeting that the Kansas City Federal Reserve Bank has every year at Jackson Hole, Wyoming. Watch the news on that. See that's another, we'll get some type of a direction. You'll hear a lot of people interviewed. They'll come out with what they think is going on. And so that would be something, because what's happening for us is that every day we're just trading off the economic indicators and looking forward to the next Fed meeting. And so now we have, almost a month and a half for September, and it's just up and down, very volatile. And it didn't used to be this way. I mean, the bonds were pretty just simple. I mean, they had this kind of nice steep yield curve. You got rewarded if you invested out 5 years. It was a little lower if you invested shorter. And now it's just moving all over the place. So any questions over what I've just talked about? These are just more interest rates, kind of a snapshot. We put out like a fixed income overview that I'd be more than happy to share with more people in the council if they'd like to see it, or I can send it to you, Ben, or whoever else. That it's just a snapshot of where different interest rates are in the securities that we purchase. Of course, this is it's dated a little bit last week, but it'll change. And so now I'm going to move into the actual portfolio. So I'll pause for a second. Are there any questions about what I've already said
I have
about the
one
economy?
Just a recap real quick. Did I understand you say that based on the numbers and all the things you study, that a fair anticipation is from now till February, March, we're going to see a continued increase in interest rates, inflation, but you're thinking maybe in the spring, February, March, it will begin a downturn?
They'll tighten until then, and it'll begin an easing cycle. Where they start to cut rates. Or what will happen, and what the Fed's done the last couple of years, is I mean, here's the deal. I mean, we've had, I mean, even since, '08, the Great Recession and, the housing market collapse and whatnot, I mean, we've just had a lot of artificial stimulus provided to the economy. I mean, there's been, just, interest rates went low. Then, of course, we had the pandemic, and the pandemic, I think, set us back quite a bit. But what's going to happen? I mean, they're as they raise rates, they're trying to get rid of inflation. Inflation is actually worse, than higher rates. I mean, we need inflation to go away because we can't buy as much here. I mean, it's creating a strong dollar if you want to go like overseas. I mean, it's a great time to go. I mean, I've never been to Europe, but I mean, if you can afford the plane ticket, it's probably a good time to go because we have a very strong dollar. You can buy more, overseas than you can here. But that's affecting the rest of the global economy at the same time. So so what the Fed does is they're trying to raise rates and they're trying to create a soft landing. They want inflation to go away and they don't want the economy to go into a recession. Historically, what happens is the Fed overshoots one way or the other. And like I'm not trying to defend them, but it's an art. It's not a science. I mean, there's just so many variables that go into the equation. I majored in economics, and that was the one thing that I liked is we made lots of assumptions. A lot of the assumptions didn't come true. I mean, but you can create a theory based on predicting how people are going to behave or markets are going to behave, but invariably they don't. And so during my career, what I watch is the yield curve. I don't listen to the news. I don't listen to, there's no shortage of opinions, out there. We have all the social media. We're inundated with news every 2 seconds. And when rates keep falling and the yield curve inverts, that's typically a sign of an economic slowdown. And, are we in a recession today? I mean, they may come out in 6 months or a year and say yes. It always takes them. And then people have always said that, economists have predicted, 14 of the last 10 recessions. So you got that going for you as well. So, but yes, what I am telling you today is that I do feel that looking what the yield curve's doing now and what interest rates are doing is that we are headed towards some type of an economic slowdown. And we're going to see it like after the summer, I think. People are going to buy less plane tickets. You're hearing it from Walmart. You're hearing Microsoft laying people off. There are people that are getting their companies ready for some type of a slowdown. And that's, watch the news, see what, Ford said they're going to lay off 8,000 people to focus on the electric vehicles. I mean, I don't know how that's going to affect, their company. Another thing that I saw, I was reading a part of an article today, there's supposed to be some type of a reconciliation bill now that's going to go through Congress that Senator Manchin was not for, but now he is for. And what it is, it's more credits for green energy. And what they're going to do is they're going to raise everybody's taxes. And that's what everybody's upset because he was against that. So somebody made a backroom deal. Something good's going to happen for West Virginia to get that vote. And what's going to happen with they're putting more power to the IRS. The IRS is going to find, it's not going to be the Warren Buffetts and what's the Facebook guy? It's not going to be these $1 billion, net worth type people. It's going to be everybody. They're going to try to enlist, more employees to, look at everybody's tax returns and they're going to raise taxes. And what happens when they raise taxes? It, typically affects the economy. I mean, it decreases growth. And so the midterms are coming out. There's a lot going on. So we'll see, where we end up. Any questions?
Let's move on. Thank you.
And I'm not trying to be real opinionated. I'm just trying to look at the numbers.
Doing great.
And tell you, because I could come back here next week and quite frankly have a whole different presentation just because the markets are moving around everywhere. So stay tuned, right?
This afternoon it'd be different.
What's that?
I said this afternoon it'd be different.
I know, thank you, yeah. And I'm more than willing to come back. I enjoy doing this. If you guys ever want me to come back, and I've done this a couple times in the past. I'd like to keep doing it. So let me know, and then I get a chance to get to know you guys better, and then you have more questions all the time. So let's move into the portfolio. So here's here's kind of where you're at. This doesn't include your, like the cash that you have. These are just your actual marketable securities. So you guys have, par value of 54 million as of the end of June. So these numbers are based of as the end of June. We'll go ahead and talk about the elephant in the room. I mean, kind of where you're at right now is that $54 million does have a $2.8 million loss. And what I want you to understand about that loss is that's a market value loss. I mean, so if you buy a 1% 2-year treasury a year ago, and all of a sudden the 2-year treasury is at 250, I mean, the 1% bond is going to have to be offered at a discount, right, to get a higher current market yield. So hence, that's why you have losses. Everybody in the world that has a fixed income portfolio has losses. Some have losses a lot greater than this. The reason your portfolio, let me go one little bit farther here. Your tax equivalent yield in the portfolio, and we use tax equivalent yield just because we use this report for a lot of different accounts, and we use it for people that buy tax exempt securities. That's why we use a tax equivalent yield. However, for you, there's no benefit for a tax exempt bond. But right now the yield is a 123 with a duration of 2.82 years and an average life at 2.95. And so if we go down to the June 22nd market value distribution, you'll see that 71% of the portfolio is invested in what we call CMBSs. CMBSs are commercial mortgage-backed securities. And so what's happened over the course of the last 10 years, the way I look at things when I try to buy stuff is I'm trying to find spread over treasuries. Treasury's the gold standard, right? It's backed by the U.S., the U.S. government. Good faith and credit to the U.S. government. So that's the gold standard. So what I'm looking for is I'm looking for spread over treasuries. I'm trying to find bonds that we can get a higher yield. And with the CMBSs over the course of the last several years, those spreads have been pretty wide. And what happens is we're buying, there's different types of bonds, and I don't have them all listed through here, but there's types of bonds that have, they're single loan, like apartment complexes around the country. And you look at them like a credit. They have debt service coverage ratios, just like you hear in your bond issues and whatnot. We look at the occupancy levels, the year that it was built. We look at the loan to values. I mean, it's kind of like analyzing a credit, analyzing a loan. But the beauty of these is they're guaranteed by U.S. government agencies, government-sponsored enterprises, Fannie Mae, Freddie Mac, Ginnie Mae. And so what happened over the last couple of years, we've been buying these. They all have yield maintenance provisions. They have prepayment penalties, to protect you from getting the money back too fast. So on top of a treasury, we would look at just a regular bullet agency. That would be like a Fannie Mae or a Farm Credit or a Federal Home Loan Bank. And then so what we're able to get in the CMBSs, we're able to get higher yields. We're getting and they pay just like a bullet. It's not like a residential mortgage. And residential mortgage pools don't work for municipalities as much because most people have 10, 15, 20, 30-year mortgages, and if you're only able to buy a 5-year stated final, a lot of those don't work. And so you might find one that's super seasoned, but what they do is they provide cash flow every month. They have principal and interest, just like if you have a mortgage and you make a mortgage payment every month, part of it's to principal, part of it's to interest. And so those provide cash flow for people, and those are typically purchased by other types of accounts. But what the CMBSs have done is we've been able to get 40, 50 basis points spread over treasuries with no credit risk. I mean, we're still buying a bond that has, it's backed by the full faith and credit of the Fannie Mae or the different agency. And so we've been doing a lot of those with insurance companies, banks, municipalities. And then the beauty of those is that you can get a $500,000 block or $1 million block or $2 million. I mean, there's sizes, there's scale. You can purchase a lot of that. So again, you have a 123 yield, the duration's 2.82 years, and the average life is 2.95. And the reason I bring that up is that when you look at agency bonds, there's a type of an agency bond called a callable agency or a step-up agency. So a step-up agency, real quickly, would be like you buy a 5-year step-up, And you might buy a 2% coupon today, it steps to 3 next year, steps to 4, 5, and so forth and so on. But they always have call options attached to them. And that call option gives the agency the opportunity to call that away from you. So what normally happens is they call that away from you at the worst possible time. When rates are lower, because it's just like refinancing your house. Think of it that way. They'll refinance that bond because they can issue that debt at a lower rate. So what I try to do is I try to limit, we call that convexity. I try to limit the amount of optionality or convexity in some of these municipal portfolios. And I'll show you mathematically what I'm talking about here in a minute. So we have 17.5% in agencies and in CDs. CDs used to be a really big component of this particular portfolio. And the reason being is before we went into this pandemic, prior to 2020, so if it's 22 now, in 2017, there were some CDs purchased for this portfolio that had much higher rates because banks needed the deposits. All of a sudden, the whole market was flush with liquidity. And so, I don't know if anybody's gone to their bank in the last couple of years to try to get a CD, but the CD rates were practically zero. They were through treasuries. You could go buy a treasury, or you could go buy some of these other bonds and get better yields. So that's why we've seen kind of a migration away from the CDs, away from the agencies, and into more like the CMBSs. And all this ebbs and flows. Going forward, the CMBSs at some point might not have this spread. We'll just have to wait and see. They still do today, so we'll see what happens going forward. If you want to, let's see, I don't have to spend a lot. Well, you can see, like, if you look at this and go to the again, I don't want to get into the convexity argument a whole lot, but if you go to the convexity column, you'll see that your CDs are positively convex. And what that means is that if rates fall, they actually gain more, like their market value is better than if rates went up, okay? And that's what you're looking for, something that doesn't have optionality, something that can't be called away. The agencies, you'll notice that they do have a little bit of negative convexity associated with it because those are going to be callable agencies. You buy the callable agencies because you get a little bit better yield than if you buy a bullet agency or a treasury, but you run the risk of that agency calling the bond away, or if rates go way up, it doesn't get called, so you have to live with it till the maturity. Again, I go back to my comment earlier that the beauty of being a municipality is that you're not buying 15-year final maturity paper that has a lot of interest rate risk. You're limiting it because you can only buy out 5 years. And if you go down to this CMBS column, again, you can see that those are positively convex as well. So that's a good thing. I'm not going to go into the duration. I kind of want to get probably more into so this would be another example here. Market value report. This is what talks about that, the gain or loss, the unrecognized gain or loss in your portfolio. And when I talked about the convexity again, if you look at the left column, the minus 100 basis point column right here, again, if you see down there, it gains. If rates go down, you gain 2.8% in your market value. If you go over to the corresponding column up 100 basis points, you lose the exact same amount. Hence, that positive convexity. If it was negatively convex and there was more market value risk, that number would be much larger in a rising rate environment, if that makes any sense. Again, and we could talk about that more sometime if you guys have more questions, but you have minimal interest rate risk, in my opinion, in your investment portfolio by design. Here's a market value shock. It talks about what happens, and you can see that if rates were to fall, your market value gets better. It's not going to be as bad. The losses decrease. And you're probably already seeing that. July was a really good month for stocks so far. It was also a pretty good month for bonds. The prices went way up and yields have gone way down. But that's the part that we're struggling with the Fed raising rates. We didn't think that would happen. Kind of the same, that's not it, let's see. And this is where that optionality is. I talked about, if you want to look at it at another time, that you just, again, you don't have a lot of interest rate risk. You don't have a lot of optionality in the portfolio, and that's what this is showing. Cash flows. So this is the part that's important to me. So we have, going forward a year from June, you can see, we have different cash flows, the bar charts. On the right-hand side, there's a key that will tell you the type of bond that's providing that particular cash flow. And what I look at more would be this chart. So it talks about the next 5 years. And if you go over to the right side, it'll tell you the total. So going forward in a year, we have 5.3 million. There may be there's a few callables in there. They could get called if rates fall, but they were purchased at a time when rates were pretty low. So the chance that they get called are kind of slim to none at the moment. But you see we have most of our cash flow, or almost half, coming due in 3 years. And that's kind of what we try to do, is try to keep things fairly short. But the issue right now is when we have this inverted yield curve, so what we would do if it was a steep yield curve, we would backfill some of these 2 and 3 year buckets. So we had money coming due if we thought rates were going to go higher. But what we actually have to think about now is, what the cash flow needs of the city are, and if all this is pretty sticky and core dollars to stay in the investment portfolio, there may come a time here that we start saying, hey, we need to start putting more out in the 4-year space and even the 5-year space to lock in some of these higher yields before the Fed starts to drop rates. I'll take a pause just real quick. Does anybody have any questions about what I've said thus far? So what happens, and this happens with municipalities, it happens with financial institutions, it happens with everybody in the fixed income market. When rates are low, everybody has a lot of excess liquidity. And it's because banks aren't lending money, the economy's not doing very well, they're trying to cut rates to grow the economy. So what ends up happening is every fixed income investor always buys lots of investments when rates are the worst. And then when it comes time to capitalize on the higher rates, they typically have less money. So we kind of call that the bond trap. And so we have to try to, in times like this, instead of the natural instinct would be to say, hey, let's buy that 3-month treasury, not the 2-year treasury, but there'll come a time during that 2 years that you'll probably be happy about the 2-year, not the 3-month, because rates will probably fall. And then in 3 months, you have to invest those dollars at a lower rate. Does that make sense? Monthly cash flows, just another breakdown of what cash will be coming due over the next 18 months. So it's total $7.1 million. Rate flow, these are the rate shocks, like I was saying earlier. So if the Fed were to continue raising rates or even cut rates, if they cut rates, some of the bonds that you might own get called away. But if you look at yours, again, you go across the different rate environments, and most of your numbers are pretty much exactly the same thing. And that goes back to my point earlier that there's just not a lot of optionality / convexity in your portfolio. So what we've done, we haven't bought all treasuries. We bought other types of investments to get higher yields, but we didn't take on any more interest rate risk. Again, more cash flow charts. And that's kind of where I stopped. So I've tried to, along the way, talk about as we look at future purchases, as I watch the market, there may be a time that 3 to 5 year bucket still looks like the place to go. So again, and that changes all the time, but we've seen rates, the 5-year treasury was up to 3.20 last week. And now it's down to what I say, it's 260 something. And that's a huge move in fixed income. I talked to an account last Thursday, and I told him to buy 25 million of the 5-year treasury at 3.20. He was busy, missed my message. I shot him a message before the market closed that afternoon, and I said, had we bought that bond that I suggested, you could have sold it by 3 o'clock and made $250,000 because rates had fallen that much and the price went up. And we just haven't seen that in a long time. So I thought I was getting into a very boring business when I started this, but it's over the years it's changed, and it has a lot to do with just, I didn't know we were going to have a pandemic. I didn't know we were going to have all this liquidity. And so we're just trying to, every day is a different day. So that's what keeps it interesting for me. So thank you for letting me present. Are there any other questions?
Any questions?
And if you don't have a question today,
Yeah.
and you go home and you look through this, I gave Mayor one of my cards. I can give everybody else a card. Just call me. I mean, this is the stuff that I like to do. I mean, I love to educate people and talk about the markets.
This was very educational, Patrick, and we really appreciate the presentation.
And I'm more than willing to come back on a more frequent basis too. I mean, maybe with everything going on in the world today, it might necessitate like a more frequent visit too. I love coming to Branson. I was just talking earlier, like my son's played at the ballparks when married. I mean, I've been down here a lot, so easy trip from Kansas City.
So to remind everybody online that this presentation will be recorded and available, because this was a lot of information we were just given, and so we'd have the opportunity to go back and revisit this. Thank you, Patrick.
Yep, you're welcome. Thank you.
Just to kind of wrap his presentation up, we do look at things when we go to a new client, and Patrick hit on a lot of them. Marginalizing or minimalizing the interest rate risk, where that interest rate that goes up and down, you're trying to make it steady, and then maximizing your return. The third thing is diversity of your portfolio, and he showed you the pie chart that shows where ours are. One of the reasons that I've always advocated for somebody like a Mike or a Patrick is exactly what he's saying. On a day-to-day, hour-to-hour basis, things can change. And I know as finance directors, most of them aren't expert interest. By hobby, they may track it, but he does it for a business. So I think that's a very valuable service that we've had, especially with $54 million in the economy. He can make a big dent or big difference for us. The other thing I've got to mention is any kind of cash needs that come up. This last week, we talked about part of the new public safety building, any kind of land acquisitions. He's directly involved in cash needs, and that goes through Jolene in our office. So anything like that that comes up, we plan that out. So before we have to close, we need to be able to call one of those securities. He'll take a look and see what we've got in cash, what makes the most sense. And then on a regular basis, as other investments come up and we've got to renew something, we have that conversation again. So that way we can put it out there, and he gives us this kind of conversation we do on a regular basis. That way we stay in the know. I say we, it's all of finance that's doing this. So it's a big part of what we do. So thank you for coming down. That wraps up city investments. The next one's the dashboard. You're going to have them pull up just the first page. I've just got a couple highlights on this one. The cumulative sales tax is 22% right now over the expected budget through the end of June. We're 15% over 2021 and 22% over 2019. 2019 being 2 years ago, that's a fairly even increase. Tourism tax is 47% over budget, 102% over 2021. We saw the first 6 months has exploded past 2021. And then we're 44% over 2019. The water, sewer, and ad valorem are really dead even for 2021. They're not moving much. They're cyclical, obviously. In Missouri, obviously, Hancock Amendment doesn't allow you a whole lot of wiggle room in ad valorem. So those are fairly no-brainers. I went back and modified the graphs here just to put the legends on them and continue to improve them. I've also included the tourism tax by class just to kind of show you some of the bigger items there and how they're doing. Not going to go through it in a whole lot of detail because I think that's what you guys were looking for last time. You can read through it. As you have questions throughout the year or need more information, please go ahead and let us know. But any questions on that? Because that directly relates to the next thing I want to talk to. Can you bring up the economic outlook? And I say that with tongue in cheek. He just gave us an economic outlook. So go to the bottom of this one if you would. I want to bring up, the thing I want to bring up here is our forecast and what we're looking at. Understand, right now we're in June with data, right? So this is really this is based on what we have right now in information. And you're looking at the negative in 22, outlook for the end of the year is a drop in sales tax. And we looked at this independent of the conversation we just had with Patrick. And remember what he had said, companies are setting themselves up for a drawback in that expense. Well, what are we doing? Right now, we're trying to be conservative, but not overly conservative, to show 21 was an anomaly. It still is an anomaly. And it will be for the next few years until we get to that mark. 3% drop over in 21 is still well over 2019, well over 19. But it's still a 3% drop. What that's doing is recognizing that anomaly in 2021, but the fact that our next 6 months is going to tell us a lot, right? So just out of the gate, what we did was take a look at your last 20 years of collections. What that does is educate us, and I'm talking about July to December. That educates us enough. Guys back in Kansas City, like Patrick, are much smarter than I am when it comes to this stuff. They've got programs that will give us an initial read based on your history of what that number should be. When we started looking at it, it was a 13% drop. That was with April. Then it went to a 10, and with June, it went to a 3. Now, these guys are saying right now they wouldn't put money anywhere on having that either be 0 or an increase. So that kind of tells me that they're pulling back a little bit. But then right now their outlook for 23 and 24 is kind of a flattening out. Now that's something I want to see, because that flattening out is still well over 2019, right? That tells us that, one, the population's up, and by 23 and 24, people would be back to spending at a level about on par with 19, just with higher prices, right? And then the travel is the negative 10 I've got to see. I'd really like to be a soothsayer and know what the next 6 months look like, because with airplane tickets being as high as they are, you see a lot of commuter travel. A lot of people from Kansas City coming down to Branson because they won't want to spend the money to fly to Florida, right? The hotel I'm staying at, every time I've been here, they've been full. They've been busy. There's always something going on. So that tells me that I'm wondering if that 10% is really going to take place, but that's what we've got it, 10% decrease. And it's the same thing. 10% decrease over 2021 is still a huge increase over 2019. I've also threw in there what the collections were for each one of those months, just to kind of show you. Sales tax collections, you can see the kind of around 11.5 million, right? And then we see that bump up to 2021. The big caveat here is this changes as time moves forward, and we change this each time we get new collections. And in the monthly report you guys get, guys back in Kansas City get that same report. We ship it off to them as soon as it's done, and they update this. And then these forecasts will change. Right now, this is what we've got plugged in for 22. What I want to do then in September, when we come back to you, and we'll get to that in the calendar, when we come back to you, we'll actually have what 22 looks like as far as the fund itself. Increase or decrease to fund balance, what does that all look like? And that'll be part of that presentation. 23 will be the same way. Right now, this budget that we're going to be looking at to work on is going to have these numbers in it. The 13.5 is what we're going to be using with the directors to be able to balance everything out. And then as that number changes, up or down, we can come back and add things into it. We'll have that prioritization process, if you will, and that conversation with all the directors that says, okay, well, here's the priority of the projects. If this happens, then this gets plugged in. And that's something I think we're really missing, is that process now with adding or subtracting some of that capital. So we'll be part of that process. We'll be 22 as well. If things end up shaping up to be a surplus, then let's put that money to work with projects. So that's something we'll be working on as well. Any questions on this one?
Ben, let me see if you can provide me with some clarity. At the beginning of this year, obviously 20 and 21 were anomalies.
Yes.
19 was a very good year for Branson. So at the beginning of this year, my thoughts were, if I knew we weren't going to come near the 2021, that's anomaly. Same with 20. So when I was looking at 19 was our last, I'm going to say consistent year prior to the pandemic. So in my mind, if we could have exceeded our 19 revenues, we're doing good.
Yeah.
When I looked at the monthly revenues, the first 6 months of the year of 21 are smaller numbers,
Right,
and the last 6 months were larger numbers.
bigger numbers, right.
So we've had over this last 3-4 months, it's been in the press that they keep quoting that we're up over 21, we're up over 21,
Yeah.
we're up over 21, which obviously, if we ended up over 21, that would be a phenomenon.
Right.
So I've been cautioning everybody that has asked my opinion that I agree our numbers today say we are up over 21. However, the last 6 months, I really see a correction in that
Yeah,
percentage. So what's a little comforting to me is, based on this first 6 months of this year, I'm feeling more confident that we are going to exceed 2019 numbers.
yeah,
You agree with that?
yeah, I do. I do. We're, at this point, we're conservative, obviously, in this outlook. 15% right now, sales tax over 2021. That's right now. Last month, it was 20. The month before that, it was 30.
Right.
So that increase over 21 is coming down. At some point, I believe it's going to invert just because of the.
Very soon.
Yeah, people drawing back. Now, the one caveat, I guess, if I would have,
Yep.
that is if we continue to sustain the visiting, the tourists that come into Branson, I don't know about you, but if I go visit, I'm not pretending I'm at home anymore. I'm
Right.
bringing cash with me because
That's right.
I want to take something back from there, whether it's a show or souvenirs so that would be an anomaly to a typical, residential forecast. So you guys have got a little bit of twist there. Out of any revenue piece that we look at across anything in the city, the two biggest, the most volatile revenues you can have is tourism tax and sales tax.
Yeah.
And that's usually diversified with ad valorem or some type of, or fee structure or whatever it is, something that's really stable. And that can have some wild swings. We saw it here. And you guys successfully managed through that. Now we've got an equally big problem in managing the rest of the way. What happens when it does return? We don't have a trend yet, right? And we won't have until maybe next year or 24 to see really what that is. That 13 million, that 2 million above 2019,
Yeah.
it could be here to stay. That may just be the new level you're playing on because you've had residential growth. And a lot of these things that you're doing, marketing the city, play a part of this right here.
Huge part, yes. So we're anticipating, and I'm not sure how long, I know you have quite a few priorities on your list, but a 3-5-year forecast.
Right, that's right.
When you prepare that, you'll be using these percentages.
Right now, right.
Yeah.
That's exactly right. And we've got it built right now. We're, with the spreadsheets that we've adopted from what finance staff's already put together, they've already got a 20, 30-year outlook in them. The only problem I've got with the 20 or 30 years is it's 20, 30 years. It's
Yeah.
kind of really hard to stick to those. Anywhere from 5 and 10 is probably more plausible, kind of give you an idea where the trends would go.
Sure.
And what you'd be looking at. So that, at least that 5-year picture will be what we're bringing back to you of the 4 big operating funds in September. So that'll be part of my presentation.
In September.
Yeah,
Very nice.
yeah. We'll update it again, obviously, but
Like September 1st?
27th.
Just kidding.
Yeah, 27th, yeah.
I appreciate you very much. This was great information. Does anybody have any questions so far?
And I got to say, I cheated a little bit by having Patrick here.
Yeah. Well, yeah, my comfort level would be so much higher with Patrick
Yeah, I
sitting
know.
here using
Yeah,
forecasted
same way.
numbers. Yeah.
But the agenda kind of shaped up really nice because we get Michael here to kind of wrap up, here's what the end of the year, and with Patrick stepping it off, here's where we're going. So that lined itself up really, really nice. And then we can't do approvals, but we've got the 50,000 and over disbursements that are in there. Let us know if there's anything you want to see, otherwise it continues to go to the council. Budget calendar, I didn't know of a whole lot. We kind of talked about that. If you want to pull it up, that'd be great. And just go to the bottom of that sheet. And if you blow it up too. So we've got the tax levy hearing coming back, your next meeting. There'll be a public hearing on August 9th. And then what we're asking here is on the study session with September 27th. September 27th will not be a budget workshop, even though that's what it says. This is my opportunity to give you a presentation of what that budget book looks like, what went into it, what the forecast in 22, 23. I want to leave you with something that you can take back then on the 6th. You'll have enough time then to go through it and ask questions. So on the 6th, we're looking at, we've already kind of went through that 1:30 to 6:30. We'll have departments come up and kind of talk about what their changes are. I've kind of got it broken down into 2 areas. What their changes for 22 and 23 are and what they're looking at coming down the road, right? Because you're dealing with not just 1 year. When you're looking at capital, you're looking at long-term. What's in that 5-year capital window? What's something we need to probably start talking about now because next year it's going to be here. And then next year being 24, we'll be here. So I kind of want to have them have that conversation on the 6th with you. You'll have the numbers. I'm taking a lot of what we've used between the budget book and the budget magazine, putting it into one budget book. And Sunday over there's the one helping me put that together. So they do a great job of that. So you'll get that. And then if we need to, we've got a study session on the 11th. That workshop, that's going to be, workshop 2 is really in the study session. I'm going to suggest that's when we bring the convention center back to kind of talk about the capital needs as part of the budget process. I'm going to reach out to them and have them part of that capital CIP. So we have that listed. And then I'll work with Lisa to get that scheduled, get a half hour or so to be able to talk to them, if that's okay. And that's really what I do. I just wanted to get your head nods that this looks good. And if
Looks
you've got
great.
any comments
think it
or
looks
improvements you want to see, good.
I'm tickled pink, and my comfort level is really high with our directors, because I'll tell you, they're really good.
Yeah.
They know, like you said, they know what's coming down the pike.
Exactly, yeah.
They know what to expect within reason in 23 and 24. So that again just produces a higher level of comfort for the decision-making.
Yeah. And the front of the introductory part of the document we're going to give you will have the changes. Right?
Nice.
What it won't have is what's in their head, what it might. What's in their head is about what's coming down, the items coming down the road. You deal with that every year, like on a water or sewer, because you got to look at rates in the future.
We could save a lot of money if we didn't get Kendall's input.
Exactly right. There's a lot of risks to that.
But he also has maintenance scheduled out.
Exactly,
You know, I mean,
yeah.
that's very impressive.
Yeah. That is the budget calendar. The last item on our agenda is the monthly reports. I'm not going to go through the monthly reports or even have them open it up, but I did want to point out that we're obviously halfway through the year. The general fund's $1.5 million revenue over expense. It's in line with 2021, which actually is saying something because 2021 was a real anomaly. You're well in excess of what your budget was estimated to be in the middle of 2022. Other funds, there are no concern across the board. When I say no concerns, I look at 2 things. What's the cash balance compared this year or this month to last month? No issues. And then the second thing I looked at is your budget estimates. Where are you against your budget estimates? With 50% of the year, within the general fund, you should be well in excess of that 50% collected, because you got certain items that are collected ahead of time, like ad valorem tax. That'll get even higher as we move forward because your sales tax that real collection months start pouring in. And then the expense side is by department and then overall fund, where do they sit with their budget? It's typically below 50%. In this case, we've got a few departments that are below 2021. So I'm not saying that's good or bad, I'm just saying that's a fact, and some of it may be just building up of a capital that is about ready to go out, so we'll see some of that change. But overall, we see it really healthy. Through June, we see it really healthy, and I'm really looking forward to September to put this together. And that's all I had for you today. 2.5 hours later, hour and a half later.
It's a lot in an hour and a half. I know, and I'm guilty of this all the time, I know you have some real priorities that you're working on. Something that may not be appealing to Patrick would be a question. I know, I see how much we have in our investments, and I appreciate the yield and that gamut. We also, would you review our debts? We have several different loans out there. So hypothetically, just for a concept, if we have 54 million and our yield is 1.23, if we have a $10 million debt and we're paying 6 or 8% interest on it,
Yeah, I know where you're headed.
yeah, wouldn't it make sense to take the money that's earning 2% and pay off a higher interest rate? Obviously, we want to be conscious of how much cash we have available.
Right.
But that, in my mind, that would be a risk-free return on investment.
Right.
You agree with?
I do agree with that. Obviously, I can, as a government accountant, I can give you caveats all day long, but I think conceptually, you're exactly right. Having a conversation with Patrick about here's what the debt load is and where the investments or the interest rates are, what do you think? Because between Patrick, me, and Jolynn, we could probably come up with a concept to bonds that are in their call period, we could potentially pull to pay off early. I know Jolynn brought me one account payable that is, and I can't remember what the issue was, that's coming up that we have the money for, and we pulled the trigger to go ahead and just get it paid off. That kind of thing is
Yes.
something we need to look at, yes. We could definitely have that.
That'd be great. I'm very impressed.
Definitely. Thank you for the presentations. It definitely gives us lots of food for thought when we decide on what we're going to invest in, what we're going to spend money in and spend money on. Thank you.
You're welcome.
Well, my wife doesn't ever let me see these many numbers.
We got this from your checking account, buddy.
So for the people in the back of the room, like if we had to give it a grade, A, B, C, or D, what's our outlook? I mean, current position,
Financial overall,
financial overall,
definite A.
right?
And you have that rating anyway. If a
Right.
formal rating for that matter, Standard & Poor's and Moody's, it looks at everything.
Right.
But if you're just looking at your cash balance, your overall financial health, I'd definitely give it A.
And that is attributed to just, again, like staff and the
Yeah,
oversight of your
Absolutely.
expertise and Patrick's expertise is just really, I mean, everybody's hitting on all cylinders. And the responsibility of the board to be stewards of the taxpayer money.
Yeah.
I mean, that's just, it's just the effect of everyone making great decisions and everyone being very knowledgeable about what's going on and having that forecast ability. And so thank you so much for what you did present. That was great.
You're welcome. And I would, Mayor, ask that we have Patrick come back toward the end of this year, maybe October, November-ish, to kind of give an update and see where the end of the year is. That way we can hold him to it next spring.
We would really appreciate that.
Maybe twice a year visit.
Yeah, and we'll keep all of your projections, and we'll throw them at you when you come back.
And his pay correlates with how accurate he is.
Is anybody in the audience have any questions on what we've seen today? Budgets? Lisa, any questions?
I
Yeah.
have a couple of questions for the board or for those who, it's the board.
Yeah.
So we're looking at coming back on the next board meeting, and we talked about I didn't know if there was something specific you want to add that you would like to bring back, so we know what to bring back. The audit comes back to the full board. But any other information that you'd like to be brought back for the full board on that day, I think that would help give some direction
Yeah.
of what you would like to see off of this, because there was so much information.
Sure.
So for instance, I think Michael had to get back to Kansas City, but he'd already asked me if we need him to come back down on the 9th
Do
to
you
give what
think-
he gave. huh?
Yeah, do you think we do?
That's obviously entirely up to you guys. We can have him zoom in, just like in the past, and give the same presentation. It won't cost him anything to get down here. He actually suggested that. We could do it either way. I know he's wide open.
I would be comfortable with having Michael just zoom in.
And do the repeat of the audit report that was already
Yes.
presented?
I think that'd be important for the whole board to hear that, and the community. And then equally important, your comments to our current audit
Yeah.
would be appreciated.
Sure, yeah.
And the, probably that economic outlook, I would assume,
Yes.
that part.
Yeah, I'll be back down that day anyway, so yeah, I'll be here. I could do that.
The debt review that the mayor asked for, would that be
We won't
available
have- We
or?
won't have it done by then, but we can
Okay.
absolutely do it. We can set it up to actually give you information back during the budget workshop, which would be the perfect place to have some time to talk about what we're looking at.
Okay, thank you.
Yeah, that's a good suggestion.
Yeah, that'd be great.
So my other question was too, was what we kind of alluded for Patrick to come back. It would be nice to get on our report schedule. I would be happy to do that. What would be a common good time? I don't know if there's certain months that are better to have it come back and where we get on a schedule somewhat. So these aren't missed in the future to get reports back to the board. So I just heard October, November, and I don't know, once a year, twice a year, what months are the better months maybe to report on?
I would do twice a year, just being selfish. I'd want to do it like we're doing it now. It's July. I'd want to do it probably in June, because that's really when we're going to kick off, really kick off the budget is in June. And then, if you really talk about, then 12 months later, you got a holiday in there in November, so that kind of plays with things a little bit. But anywhere November to December, if we can get it on agenda, it could be a workshop, a work session
Study
at
session.
4:30. Like Patrick said, I love the drive down here. But it's the same way for him. It's not an issue.
It helps to have the timing and when we can
You bet.
schedule, and then we don't miss it. I think
Yeah.
we get it on our report schedule and we won't miss it. We'll constantly come around for us. So we'll add it to our report schedule. Thank you, that helps.
Yeah, Patrick would like to schedule it in the period of the year where he's really hitting on all cylinders.
No red on
No red?
no red on the board.
When there's no red, Patrick's on the agenda.
I don't know, he's hitting it on all cylinders right now, I can tell
Yeah.
you. I've seen people in a lot worse positions than what
I
he's
can
showed us.
imagine.
Yeah, yeah. But thank you.
Thank you very much. Is there anything else? We don't need to adjourn the meeting because this isn't a meeting.
No, I'm going to get a calendar out for the finance committee and for the board. We've got some joint meetings coming up and some things, so I'm trying to get these dates down, and we'll get them out so the calendars can be, and maybe try to get people's calendars blocked,
Yeah.
because these are different dates than your normal meetings. And I don't know, I think you're planning on continuing to have your finance committee meeting, or are you going to? So August.
September, I'd like to combine it
Okay.
between, well, yeah, September, October, August we'll have one.
Okay.
But September we'll combine them with the,
So September will be a different date than what we normally have for finance
Right.
meeting, because we're going to combine it. Just trying to get a calendar going, so I know it's easier to block calendars ahead of time.
Sure, sure.
Thank you.
Ben and Patrick, I really appreciate what you've provided us today.
Thank you.
And with no questions from the audience, we will unofficially adjourn this unofficial meeting.